Two people, same city, same year, both earning $250,000. One of them has a salary, a brokerage account they check on Sundays, and a vague plan to figure out the structure stuff later. The other one has a balance sheet. Not a big one, not yet, but a real one, with accounts that have names and purposes, entities that hold different kinds of risk apart from each other, a written policy for what happens to surplus before lifestyle gets to vote on it. By year 10, the distance between them is not explainable by income. It is not explainable by hustle. It is explainable by structure and the habits that structure forced into existence. That is what this is about. You are not starting at $100 million. Nobody starts there. You are starting at the moment the income gets real enough to matter and early enough that the decisions you make about routing it will compound quietly for 20 years before you fully understand what you built. So we start at level one. Level one, you are a freelancer or an independent consultant, maybe a designer, a software contractor, a marketing strategist, a coach. Your revenue is somewhere between $60,000 and $180,000 a year, depending on the year and the clients. You have been depositing checks into your personal checking account and paying taxes once a year in a lump sum that makes you feel briefly ill. You have been meaning to set something up. This is the year you actually do it. You form a single member LLC. In most states, it costs between $50 and $500 to file, plus an annual report fee that runs $20 to $300 depending on where you live. You open a dedicated business checking account the same week. Not the same month, the same week. This is the first habit, and it is the one that everything else sits on top of. The business account receives all client payments. Every dollar of revenue lands there first. Your personal account receives a deliberate owner's draw, a number you chose, not whatever was left over. This is called profit first in the popular literature, and the underlying logic is sound regardless of what you call it. Before the draw leaves the business account, you move a percentage into a tax reserve account. The number that surprises most first-year LLC owners is how high that percentage needs to be. Self-employment tax alone is 15.3% on the first $168,600 of net earnings. Add federal income tax at your marginal rate and state tax, and you are looking at setting aside between 28% and 35% of net profit before you touch any of it as income. You do this automatically on the first of every month. You do not wait until April to feel the number. What the LLC actually protects is narrower than most people think. It creates a legal separation between your business liabilities and your personal assets, but only if you maintain it. The moment you commingle funds, pay personal bills from the business account without documentation, skip the formalities, the separation becomes arguable, and courts have repeatedly found it to be fictional. The structure is not magic. It is a container that works only if you treat it like one. Your insurance stack at this level is 3 policies. General liability, which covers third-party bodily injury and property damage, typically $400 to $900 per year for a solo service business. Professional liability, also called errors and omissions, which covers claims that your work caused a client financial harm, typically $500 to $1,500 per year depending on your field, and a personal umbrella policy layered over your existing auto and renters or homeowners coverage, typically $150 to $300 per year for $1 million in additional coverage. Total annual cost somewhere between $1,050 and $2,700. This is not optional if you have anything worth protecting. Bookkeeping runs $200 to $500 per month if you hire it out. A CPA who actually understands small business taxes and does not just file what you hand them will cost $800 to $2,500 per year for a basic return and quarterly estimates. These are real costs. They are also the cost of not improvising at scale. Now, the first holdco mindset rules, 4 of them, written down, not remembered. 1, separate accounts are not a preference, they are the minimum viable structure. 2, you close the books every single month, not quarterly, monthly. You look at what came in, what went out, what the tax reserve holds, and what the reinvestment target is. 3, the owner's draw is a policy, not a mood. You decide the number based on a budget and you change it deliberately, not because the account balance looked comfortable on a Thursday. 4, you write down what percentage of profit stays in the business before lifestyle gets to expand. 15% is a reasonable floor. The number matters less than the fact that it is written and honored. Level 2. Revenue is crossing $100,000 to $150,000 in net profit, and you start hearing about the S-corp election. Here's what actually happens. With an S-corp, you split your income into reasonable W-2 salary and an owner's distribution. The distribution portion avoids self-employment tax. On $150,000 of net profit with a $75,000 reasonable salary, the self-employment tax savings could be $5,000 to $8,000 per year. The cost of making that work is real. Payroll processing, roughly $500 to $1,500 per year through a service like Gusto or ADP. Additional CPA complexity, often $1,500 to $3,000 more per year. Corporate formalities, minutes, resolutions, more careful bookkeeping. The math usually starts to favor the S-corp somewhere between $80,000 and $100,000 in net profit. Below that, the admin costs eat the savings. What the S-corp also enables is a solo 401k or a SEPIR, AIA funded at a level a W-2 employee at a large company cannot match. A solo 401k allows up to $69,000 in combined employee and employer contributions in 2024 if the income supports it. That is a retirement account that is also a tax deferral engine that is also a wealth building vehicle that operates entirely inside the structure you already built. The failure modes at this level are specific and recurring. Commingling funds is the most common. Under withholding taxes is the most expensive. Confusing gross revenue with actual cash profit, phantom profit on an accrual basis while the bank account is thin is the most disorienting. And over-optimizing the entity structure before the business model is stable is the most distracting. The S-corp does not save a business that has no margin. The LLC does not protect an owner who ignores the separation. Structure follows substance. It does not replace it. The cash is accumulating, not in a dramatic way. In the quiet way that happens when the draw policy holds and the reinvestment percentage is honored and the tax reserve is funded before Lifestyle gets a vote. The business account carries a balance that is no longer just next month's operating cushion. It is something else now. It is the beginning of a question. The question is what you do with it. Level 3 is the first asset holding entity, not a second operating business, not a side hustle rebranded with an LLC. An entity whose only job is to own things. A rental property, a small equity check into a friend's operation, a parking lot, a storage facility, a note secured by real estate. The asset class matters less at first than the structural decision to separate what earns from what holds. Here's why the separation is not cosmetic. Your operating company has a risk profile built around service delivery, clients, contracts, errors, invoices in dispute, an employee who slips on the stairs. An asset holding entity has a different risk profile entirely. Tenants, leases, maintenance liability, depreciation schedules, long time horizons, financing that underwriters treat completely differently than business credit. When you run both through the same entity, you are mixing risk categories that do not belong together. A judgment from a tenant lawsuit should not be able to reach the receivables from your consulting clients, and vice versa. The first realistic threshold for this conversation is somewhere between $80,000 and $150,000 in accumulated retained cash after your operating reserves are funded. That might be a down payment on a small rental. A single family property at $280,000 requires roughly $56,000 down at 20% for an investment. $1,000 down at 20% for an investment loan, plus $8,000 to $12,000 in closing costs, plus a capital reserve you hold back because the inspector's report is never the full story. Call it $75,000 to $85,000 all in before you call it ready. The return expectation is not a number you find on a forum. It is a number you model against the actual rent, the actual vacancy rate in that specific market, the actual property tax, the actual insurance premium on an investment property, which runs higher than owner occupied, and the actual management cost if you are not the one fielding the 11 p.m. calls about the furnace. A reasonable unlevered yield on a stabilized single-family rental in a middle-tier market is 5% to 8% annually before appreciation. With leverage, cash-on-cash returns can look higher in the short term and more fragile in the medium term. These are not passive income in the Instagram sense. They are a second business with a physical location that cannot be emailed. The new LLC that holds this property is a separate filing in most states. Another $50 to $500, another annual report, another checking account, another set of books that close every month. Accounting complexity goes up. You are now running at minimum 2 entities on different fiscal rhythms with different depreciation schedules and potentially different state filing requirements if the property sits in a different jurisdiction than the operating company. The CPA relationship that cost you $2,500 a year at level 2 may cost $4,000 to $6,000 now. That is not waste. That is the price of a structure that holds. Insurance at this level adds a landlord policy on the rental property, typically $1,200 to $2,000 per year on a single family. And you revisit the umbrella coverage to make sure the limit still makes sense against the total asset value you are now carrying. The umbrella that was sufficient at level 1 may need to increase. The cost difference between a $1 million umbrella and a $2 million umbrella is often less than $100 a year. The difference in what it protects is not small. Level 4 arrives when the operating complexity justifies a management entity sitting above the operating companies. What the management company actually does is specific. It holds the brand and intellectual property. It employs the shared staff, the bookkeeper, the executive assistant, the OPS person who touches multiple businesses. It handles centralized billing and payroll. It charges the operating companies a management fee for these services, a number that must be arm's length, documented, and defensible to a lender or a regulator, not whatever number feels tax efficient on a Thursday afternoon. The cash flow routing model across 4 entities looks like this. Revenue enters the operating company. The operating company pays its direct expenses, funds its own reserve, and pays the management fee upstream. The management company covers shared overhead and routes the owner's W-2 salary. Profit distributions move to the holding company, which allocates across 4 buckets. Owner compensation already paid, a tax reserve, a reinvestment bucket that funds growth inside the operating companies, and an asset acquisition bucket that accumulates toward the next property or equity position. Emergency liquidity sits in the holding company, not in the operating entities, because you do not want a slow quarter in the business to threaten the mortgage on a rental. The failure modes at this level are more expensive than the ones at level 1 and quieter in how they arrive. Related party pricing mistakes, charging a management fee that is either so low it looks like a distribution, or so high it strips the opco of working capital, are the kind of thing that creates problems with lenders and raises flags in audits. Sloppy intercompany loans, money that move between entities without a note, without an interest rate, without a repayment schedule, become a problem when a bank underwrites a new acquisition and wants to see clean books across all affiliated entities. Some lenders will simply not finance a borrower whose entity structure they cannot trace in 20 minutes. The structure that was designed to protect you can become the reason the deal does not close. Partner disputes in asset holding entities are different from partner disputes in operating companies because the assets cannot be easily liquidated to settle them. And the trap that catches more people than almost any other at this level is the one that sounds like sophistication. Too many entities, not enough profit to justify them. 4 LLCs generating $180,000 in total revenue with $40,000 in combined admin, accounting, insurance, and filing costs is not a structure. It is overhead wearing a strategy's name. The entities are not the destination. The assets inside them are. By the time you're sitting across a conference table from an estate attorney reviewing a document you did not expect to need for another decade, the structure has already outgrown you, not in a bad way, in the way that anything real and durable eventually does. It is bigger than your attention span. It is bigger than your memory of which entity holds which asset. It is bigger than the version of you that started it. Level 5 is a moment the holding company becomes a family system. The architecture at this tier has a parent entity at the top, not a concept of a parent entity. An actual LLC or C-corp with its name on the ownership documents of everything underneath it. Operating companies below it, real estate LLCs below it, a separate brokerage or investment vehicle below it. The parent entity owns all of it. You own the parent entity. This is not the same as owning everything personally through a tangle of accounts and separate logins and a spreadsheet that only you can read. The consolidation matters because it changes what is possible later. It changes who can step into the structure if you cannot. The net worth range where this conversation becomes urgent is somewhere between $5 million and $15 million. Below that, the complexity may outpace the benefit. Above it, the delay has already cost something. At $8 million in total assets spread across operating businesses, 3 rental properties, and a brokerage account, the absence of a consolidated parent entity is not a quirk. It is a liability. The daily life change at this tier is not subtle. You stop being the person who does the work and you become the person who allocates capital. These sound related. They are not the same role. You are reviewing dashboards quarterly, sometimes monthly, not to find out what happened, but to decide what happens next. Formal budgets exist for each entity and roll up to a consolidated view. Capital expenditure planning looks 18 months out. The question you ask most often is not how do we grow revenue? It is where does the next dollar go to produce the best risk-adjusted outcome across the whole system? That shift is cognitive before it is structural. The structure only works if the mindset already made the move. Level 6 sits around $25 million in net worth. The machine needs an upgrade, not an expensive hobby's worth of advisors. A real team with defined roles and accountability. A CPA who specializes in multi-entity structures and does not flinch at consolidated returns. An attorney who understands both business law and estate planning, not as separate departments, but as one interconnected problem. An insurance broker who reviews total exposure annually and whose job includes finding the gaps you did not know to ask about. A commercial banker who knows the full picture across all entities and can structure credit intelligently against it. A fee-only investment advisor managing the brokerage vehicle with a written investment policy statement that has been reviewed by someone other than the person who wrote it. This team costs money. Annual accounting at this scale runs $18,000 to $40,000, depending on complexity and number of entities. Legal retainers or project fees for ongoing governance and estate maintenance, another $10,000 to $25,000 per year. Insurance across the whole system, umbrella limits that have likely climbed to $5 million or $10 million, commercial coverage on operating companies, landlord policies on every property, directors and officers coverage. If the structure involves outside investors, total premium budgets of $20,000 to $50,000 annually are not unusual. Investment management fees on a $5 million to $10 million brokerage vehicle at 50 to 75 basis points is another $25,000 to $75,000. The advisor overhead alone runs $70,000 to $190,000 per year across the full team. That number needs to be internalized before it is resented. It is the cost of the reporting, the risk management, the compliance, and the institutional memory that the structure requires to survive its own complexity. The estate planning layer is where most founders wait too long. A will tells the court what you wanted. A trust tells the assets what to do without asking the court at all. At $5 million and above, the distinction is not philosophical. A revocable living trust avoids probate. An irrevocable trust, structured carefully, can move appreciation out of your taxable estate while you are still alive to see it compound. The federal estate tax exemption is not permanent. Its current level has a scheduled sunset, and the political environment around it is not stable. Planning against a moving target is uncomfortable. Not planning is worse. Buy-sell agreements in operating companies answer the question no one wants to say out loud at the founding meeting. If you die, if you become incapacitated, if a co-owner wants out, what happens to the equity? Without a written agreement, the answer is determined by whoever can afford the litigation. Beneficiary designations on retirement accounts and life insurance policies need to be aligned with the trust structure, not left at defaults set a decade ago when the structure was simpler and your family was smaller. Control and economic ownership can be separated. A family member can hold an economic interest in the holdco without holding voting control. This is not a trick. It is a documented design choice that allows the operating adult to make decisions without requiring unanimous consensus from people who are not operating anything. The governance documents, the operating agreement, the voting rights, the distribution waterfall, these are the mechanisms. Written, reviewed, updated when the family changes. The internal capital stack needs written policies before it needs anything else. Intercompany loans require promissory notes with interest rates that reflect something close to market. Cash sweeps from operating entities to the holdco need a schedule and a documented rationale. Guarantees that one entity extends on behalf of another need to be tracked and factored into each entity's standalone risk profile. Family money without written policies does not stay neutral. It finds the friction points, it finds the fairness questions, it finds the sibling who feels the distribution was not equal and the spouse who feels the governance was not transparent. The document is not bureaucracy. The document is what prevents the conversation from becoming a rupture. The failure modes at this level are quieter and more expensive than anything that came before. Key person dependence, a structure that only functions because one person understands all of it, is a succession plan that ends at the ICU. Lifestyle leverage, personal expenses that quietly expand to match the structure's capacity, erode the reinvestment that justified the structure in the first place. Concentration risk in a single operating business or a single real estate market is the kind of exposure that looks fine until the industry shifts or the city changes. Tax surprises from sloppy intercompany transactions or missed filing deadlines in multiple states arrive as penalties and interest and occasionally audits. The holdco that survives you was not built by accident. It was governed. At $100 million in net worth, the structure is no longer a founder's tool. It is an institution. It behaves like one. It requires management like one. And if you do not govern it like one, it will eventually fracture like one. This is level 7. The infrastructure at this tier has a name in the industry: family office light. Not a full single-family office with a $500,000 annual operating budget and a dedicated trading desk. Something more proportionate. A controller or fractional CFO who produces consolidated financial statements across all entities on a monthly basis. An audit-ready posture, meaning books that could withstand a third-party review without 6 weeks of reconstruction. Document retention protocols that are actually followed. Institutional-grade insurance. Umbrella limits at $25 million or above. Directors and officers coverage on every entity that has outside relationships, cyber liability, key person coverage on anyone the structure depends on operationally. Consolidated compliance across multiple states, multiple entity types, multiple tax elections. The overhead for this infrastructure is not symbolic. Controller or CFO support at this scale runs $80,000 to $150,000 annually. Whether that is fractional or full-time depends on transaction volume. Consolidated reporting and audit-ready accounting from a firm that handles complex multi-entity structures adds another $40,000 to $80,000. Insurance use and to $80,000. Insurance premiums across the full system, $50,000 to $120,000. Legal retainers for ongoing governance, compliance, and document maintenance, $30,000 to $60,000 per year. Total infrastructure overhead of $200,000 to $400,000 annually is not unusual at this tier. That number is not a failure of efficiency. It is a cost of operating a system that is too large and too consequential to run informally. Governance is what separates wealth that survives from wealth that settles estates. At $100 million, informal decisions are a liability. The governance layer needs an investment committee with a written charter, defined membership, a meeting cadence of at least quarterly, and documented minutes. It needs an investment policy statement that specifies asset allocation targets, concentration limits, liquidity requirements, and prohibited investments. It needs a distribution policy that answers, in writing, how cash flows from the system, who receives it, under what conditions, and what approval is required for exceptions. It needs conflict of interest rules that are not suggestions. If a family member brings a deal, the process for evaluating it is the same process used for any other deal. The relationship does not change the underwriting standard. Independent advisors matter here, not because the family lacks intelligence, because the family lacks objectivity. A board-level advisor or small advisory board, 2 or 3 people with no economic stake in the outcome, who review the strategy annually and can say the thing that insiders have stopped saying, is worth more than most line items in the budget. The next generation framework is where most family structures either become legacies or become lawsuits. Employment standards for family members need to be written before they are tested. What qualifies a family member to take a leadership role inside the structure? What are the compensation benchmarks? What happens if performance does not meet expectations? These are not comfortable questions to answer in advance. They are far more comfortable than answering them in the middle of a conflict. Education funding logic needs a policy. How much? For what purpose? Through what mechanism, and whether it counts against future distributions. Liquidity events, when a family member wants to redeem their interest or exit a shared investment, need a defined process including valuation methodology, notice periods, and funding sources. Prenuptial expectations are not about distrust. They are about protecting an asset that belongs to more people than just the couple getting married. The policy either exists before the relationship reaches that point, or it becomes a negotiation under pressure. Capital allocation at this scale is a full-time discipline. The system typically holds operating businesses generating cash flow, real estate across multiple markets and asset types, private credit or equity positions with long hold periods and illiquid profiles, public market investments managed against a written investment policy, and opportunistic deals that arrive through relationships and require fast decisions. Balancing these is not intuitive. The operating businesses consume management attention. The real estate requires capital reserves. The private positions lock up liquidity for years. The public portfolio is the pressure valve. The rule at this tier is that liquidity is not a line item. It is a strategic asset. A minimum liquidity buffer, often 5 to 10% of total assets held in instruments that can be accessed within 30 days, is not timidity. It is the thing that allows the structure to act when the opportunity is real. Now, the part that does not appear in the pitch deck. Entitlement risk compounds quietly. The structure that was built through discipline and reinvestment can, over one generation, be converted into an expectation of distributions without contribution. It happens slowly, and then it happens all at once. Reputational risk at this scale is real. Business decisions, employment decisions, philanthropic decisions, they all carry the family name now. Fraud and insider threat risk rise with the number of people who have access to the system. Controls matter. Segregation of duties matters. Annual audits matter. Philanthropy pressure is a specific tax on success that few people discuss honestly. The calls increase. The requests become moral arguments. The governance layer needs a philanthropic policy the same way it needs a distribution policy. Not to say no, to say yes with intention and no without guilt. The psychological cost of being the family's central bank is not trivial. Every decision carries downstream consequences for people you love. That weight does not get lighter as the structure gets larger. It gets heavier. Build the governance so the structure can make decisions without requiring you to carry every one of them personally. Here's what stayed constant from the first LLC to this tier. Separation of personal and business assets. Discipline around reinvestment before consumption. Reporting that tells the truth before you need it to. Governance written down before it is tested. These were the rules at $50,000 in revenue. They are the rules at $100 million in net worth. The scale changed, the principles did not. If you want a deeper dive into any single tier in this ladder, the next episode goes there. Subscribe so you do not miss it. And as always, this is education, not legal or tax advice. The advisor who knows your specific situation is the one worth listening to.